Hello and welcome to our discussion today on private placement memorandum, due diligence, term sheets, and regulations. My name is Jonathan Lopez. So to start our discussion today, we're going to talk about PPMs, regulations surrounding PPMs, the creation of PPMs, the benefits of PPMs, term sheets, and then due diligence. So to begin our discussion today, when talking about private placement memorandum, we see it as defined as a document which explains a new offering of securities for private placement. PPMs are most commonly used by firms attempting to increase their capital. A PPM essentially does two things. It outlines the term of placement professionally and also protects the company issuing the PPM. Private placement memorandums allow companies to finance their equity without registration under the Federal Securities Act of 1933. Investors are then able to bypass this act by using Regulation D. Regulation D, you see, is a series of 6 rules of which establish exemptions from the requirements of the Federal Securities Act. Regulation D has separate exemptions for companies raising capital under $1 million, under $5 million, and under unlimited amounts. Companies raising both under $5 million and unlimited amounts can only sell to 35 non-accredited investors and an unlimited number of accredited investors. An accredited investor is defined as people who have an income of over $200,000 for each of the previous 2 years. Although Regulation D does provide certain exemptions, it does not exempt firms from anti-fraud or civil liability laws. So there are a lot of benefits to PPMs, and the first benefit of using a PPM is that it notifies all interested investors that the company is seeking to comply with the SEC rules. A PPM also acts as an insurance for disclosures. In addition, PPMs list all risk factors of the potential investment and warn investors of potential downsides to the investment. By initially warning investors of the risk of the investment, the PPM has protected the seller of the securities. So just like the benefits, there's also many ways to create a PPM. The first way companies create PPMs are through attorneys, and using an attorney to create the PPM allow companies to use their own management team to find and solicit potential investors. Using an attorney is most popular when a company already has an established group of investors interested in the investment opportunity. Another method to obtaining a PPM is by using an investment bank. Many investment banks contact entrepreneurs promising to raise capital for the company's startup. Many people consider investment banks to be a more risky form of creating a PPM because an entrepreneur is allowing a third party to manage the startup of their company, one of the most crucial stages to success, the startup. Lastly, the third way companies create PPMs is through the use of a PPM specialist. PPM specialists are firms which utilize both attorneys and investment bankers to raise capital. The contents of a PPM contain various things such as ratings from rating agencies, yield and prepayment considerations, use of proceeds, income tax considerations, and other various descriptions of risk and concerns. So for this reason, private placement is also a popular alternative to initial public offerings because of the relatively low cost and less time consuming of the actual placement. Private placement also has its disadvantages to go with its benefits, the main one being it's the regulation. And one of the main SEC regulations for private placement is that offerings can only be made to a certain number of investors who must meet certain criteria. So next we're going to be talking about the term sheet. And a term sheet is defined as a document prepared by an investor that sets terms for a proposed investment. And it's very important for an investor to not only focus on the overall valuation of the investment, but also to have an attorney present to help negotiating the terms. A term sheet acts as sort of a conditional offer from an investor. Term sheets are almost always non-binding and serve as a connection between the initial negotiation and the definitive agreement. If all terms of the term sheet are agreed upon, the term sheet may serve as a template to the actual PPM. Term sheets also have various terms that may be discussed, such as warrant coverage. Warrant coverage is a warrant that gives the owner the right to invest more money later at the same terms as originally agreed upon. So this brings us to our next topic, which is due diligence. Due diligence is defined as an investigation of a business or a person prior to agreeing to a contract. The term can be used as a legal obligation, but in most cases it's done voluntarily in order to decide whether it is a worthwhile investment or not. And due diligence can be defined more precisely in various ways. It could be seen as an investigation of a potential target or a merger and acquisition. It could be an investigation focusing on material future matters, an investigation completed by asking certain questions as how do we buy or how do we structure the acquisition. due diligence is also, various ways that it can be conducted. As a potential investor, you should seek to obtain confirmation that the business is doing as well as it appears to be. Identify factors that may be a hindrance to completing the deal. Due diligence is also very important for the person of the firm that is being invested in. The person or firm should make sure the investing firm will be able to participate in further investing if the company continues to grow and needs additional capital. And it's also very important to gain as much information as possible that may be useful for valuing the assets that the firm holds. Due diligence is also important because it will ensure that the transaction complies with the acquisition criteria. And what we want to say, in a more broken down form is who conducts the due diligence, and it can also be a very important factor as well. Due diligence can be conducted by investors, corporate development staffs, attorneys, accountants, investment bankers, loan officers, and other professionals that are going to be involved in the actual transaction. So due diligence must be conducted as thoroughly as possible, and all potential investors should attempt to gain as much knowledge of the company as they're able to. So due diligence, a little bit more broken down, we could see that there's three main areas of financial due diligence. Firstly, it would be the explanation of how the funds will be used. And so you can ask yourself questions as why do they need financing? Where will the capital be deployed? What is your proposed closing date? Is your stock option plan adequate? Or, who is the board composed of? These are all questions that you're going to want to ask yourself when you're deciding in the financial due diligence of the explanation of how the funds will be used. And then continuing on, we have the explanation of the business model or model budgeting. And the way this can be asked is, list of cash on hand. How fast do they use their cash? What stages and deadlines need to be achieved? What are their short-term objectives? What are their funding objectives? What will you gain in the momentum of the business? What are their marketing plans? How profitable will the company be? What's their staffing plans for the future? Like, for instance, Bank of America just got rid of 30,000 employees. I currently am holding Bank of America at $12.27, and I saw that as being very beneficial to the firm. My due diligence to the firm would be to see that, hey, they're trying to finish up or clean up their balance sheet for the long term. I saw it as a positive. In addition, what are the monthly operational expenses? What is your equipment budget? What are the current liabilities? And project and predict the future funding needs as the business grows. People need oftentimes more financing as the business grows. And then lastly, legal review. What's the corporate structure? Are there any unrecorded liabilities? An attorney review of a stock option plan, is that available? What are the contracts with advisors and what value is being added? These are all different types of due diligence, and it's really all to find out the basic information of the firm to the highest degree. Find out everything you know, because as an investor, that is your due diligence or your fiduciary duty to take care of those steps and do those steps on the betterment for your firm that you're working for, whether you're private equity or commercial banking or wherever else in investments that you're actually working. It's your due diligence to do it for yourself, your company, and for your client. In conclusion, we have talked about the private placement memorandums or PPMs, the regulations such as Regulation D, PPM creation using attorneys, investment banks, or a PPM specialist, some of the benefits or the disadvantages of PPMs, as well as term sheets, and then lastly we discussed due diligence. So thank you very much for watching, and I hope now you'll be able to leave here with a better understanding of all these topics.